A price floor? Sounds harmless, almost boring, until it becomes clear that someone, somewhere, has decided the market can no longer be trusted to decide the price. Silver? Not oil, not food, but a metal quietly embedded in power grids, data centers, medical systems, and defense hardware. Most people never see, yet rely on every day. When governments stop asking what silver is worth and start deciding what silver must never fall below, the rules change, capital shifts, supply chains tighten. Those who notice early do not panic. They reposition. Because when price floors appear, they rarely stay where they begin, and they never arrive alone. What happens next is where the real story starts. Welcome to Boring Currency Ledger. If experience has taught you that headlines fade but structure endures, this channel was built with you in mind. If you value calm analysis over noise, take a moment to subscribe. Not for excitement, but so you do not miss the next quiet warning. And before we begin, tell us where you're watching from today. When the phrase price floor enters a serious policy discussion, seasoned observers pause. Markets are designed to let prices rise and fall freely, guided by supply, demand, and risk. A price floor interrupts that process. It draws a firm line and declares that prices are not allowed to fall below it. That alone makes it unusual. When multiple governments discuss coordinated price floors at the same time, the message becomes impossible to ignore. This is not a technical tweak. It is a structural signal. In this case, the discussion centers on critical materials, with silver appearing alongside other industrial inputs. To many listeners, it may sound like a narrow policy move meant to protect producers, but economic history suggests something deeper. Price floors rarely appear in calm, well-balanced systems. They appear when decision-makers believe the market is no longer producing outcomes that match strategic reality. They appear when something is considered too important to fail. Throughout history, price floors have emerged during moments of stress. Agriculture, energy, and wartime production all offer examples. In each case, the reasoning followed a similar path. Producers were unwilling to invest at prevailing prices. Supply chains showed signs of fragility. Demand was expected to rise or remain firm even if prices increased. Governments stepped in not to encourage growth, but to prevent collapse. That distinction matters. A price floor is not an expression of optimism. It is an admission of vulnerability. Most headlines miss this point. Coverage often frames price floors as protection from unfair competition or support for domestic jobs. Those explanations are not incorrect, but they stop short of the real issue. The deeper concern is that market prices are no longer trusted to reflect strategic importance. Silver enters this discussion because it occupies an uneasy position. It trades like a commodity, yet it behaves like a necessity. It flows into systems that cannot easily function without it. When prices fall too far, investment slows, refining capacity weakens, and future supply becomes uncertain. A price floor is an attempt to correct that weakness. For businesses, this signals a shift away from purely reactive markets. In reactive markets, prices respond after disruptions occur. In managed markets, policy tries to act before shortages become visible. This changes how risk is distributed. Some volatility is removed from producers, but it does not disappear. It moves elsewhere, often into costs, taxes, or longer-term planning constraints. Coordination amplifies the signal. A single country experimenting with price floors can be dismissed. A coalition discussing aligned minimum prices cannot. It suggests an effort to anchor expectations, protect long-cycle investments, and reshape behavior across borders. Even firms that never touch silver directly may feel the impact. Price floors influence financing decisions, contract structures, and sourcing strategies. They affect how lenders price risk and how executives plan capacity. The most common mistake is assuming price floors are temporary. In practice, they are difficult to unwind. Removing them means accepting bankruptcies, layoffs, and supply disruptions. Few governments choose that path willingly. What begins as a safeguard often becomes a new baseline. The number itself matters less than the precedent. Numbers change, structures persist. Timing adds another layer. Price floors usually appear before shortages are visible, not after. They reflect expectations of rising demand colliding with supply chains that cannot expand quickly. Infrastructure upgrades, electrification, and security priorities all point in that direction. In this environment, price signals must be read differently. Falling prices do not always indicate weak fundamentals. Rising prices do not always reflect free market enthusiasm. Policy now sits between supply and demand. For younger entrepreneurs, this requires a shift in thinking. Charts and cycles still matter, but policy intent matters just as much. The relevant question becomes not only what will the price do, but what behavior is being encouraged. The appearance of a coordinated price floor is not a forecast. It is a message. It says the system is being adjusted to favor stability over efficiency, resilience over cheapness, and planning over spontaneity. When such messages appear, they deserve attention. Silver does not fit neatly into any single category, and that is precisely why it keeps reappearing in policy discussions. It is not just another metal, but it is not purely money either. It sits in between, creating confusion for markets and discomfort for decision makers. This uneasy position is what makes silver different from most materials affected by a price floor conversation. From the outside, silver trades like a commodity. Its price moves daily, it reacts to speculation, interest rates, and sentiment. Charts make it look interchangeable with other metals. But underneath that surface, silver behaves very differently. It is consumed. Once used in many industrial processes, it is difficult or uneconomic to recover. That single fact changes everything. Silver flows into electronics, power transmission, solar panels, medical equipment, and defense systems. In many of these uses, it is not optional. Engineers do not choose silver because it is fashionable. They choose it because it conducts electricity efficiently, resists corrosion, and performs reliably under stress. Substitutes exist on paper, but in practice, they often fail on cost, durability, or scale. This creates a structural problem. Demand for silver grows quietly as technology spreads, but supply does not respond quickly. Silver is rarely mined on its own. It is usually a byproduct of other metals like copper, lead, or zinc. That means silver production depends on decisions made for entirely different markets. Even if silver prices rise, miners cannot easily increase output unless those other metals are also profitable. This disconnect is crucial. It explains why silver shortages can develop without dramatic headlines. It also explains why price signals alone may not fix the problem. When markets rely on price to balance supply and demand, they assume producers can respond. In silver's case, that assumption often fails. A price floor attempts to address this failure. By setting a minimum price, policymakers try to ensure that silver-related projects remain viable even during downturns. They want refiners, recyclers, and specialized processors to survive long enough to serve future demand. The goal is not speculation. The goal is continuity. But silver's history complicates this effort. For centuries, silver functioned as money. That legacy never fully disappeared. Even today, silver reacts to currency stress, inflation fears, and shifts in trust. When policy touches silver, it does not just affect industry, it affects psychology. This dual nature makes silver politically sensitive. If treated purely as an industrial input, its monetary role resurfaces during crises. If treated purely as money, its industrial importance is ignored. A price floor forces authorities to acknowledge both sides at once. For businesses, this creates an unusual planning environment. Manufacturers care about stable supply and predictable costs. Investors care about policy risk and optionality. Governments care about security and control. Silver sits at the intersection of all three, which means decisions around it tend to ripple outward. Another layer adds complexity. Silver inventories are not evenly distributed. Above-ground stocks exist, but much of it is held in forms that are not easily mobilized for industry. Coins, bars, and private holdings do not flow smoothly back into manufacturing. When industrial demand rises, it competes with investment demand for the same material. This is where price floors become controversial. By setting a minimum price, authorities risk encouraging hoarding rather than circulation. Higher perceived strategic value can reduce willingness to sell. Instead of stabilizing supply, the policy can tighten it, at least in the short term. Yet doing nothing carries its own risks. If prices fall too far, recycling becomes uneconomic. Refining capacity shrinks. Skilled labor exits the sector. When demand later spikes, rebuilding that capacity takes years. The system becomes reactive instead of prepared. This is the trade-off policymakers are facing. Silver is too important to ignore, too complex to manage cleanly, and too small a market to absorb mistakes quietly. That combination makes it a candidate for intervention, but also a source of unintended consequences. For aspiring entrepreneurs, the lesson is not to guess prices. It is to understand roles. Silver's role is expanding, not because of hype, but because modern systems rely on it more than they admit. Energy transitions, digital infrastructure, and security upgrades all lean on materials that cannot be printed or replaced easily. In such an environment, price becomes a policy variable, not just a market outcome. That does not guarantee higher prices forever. It does guarantee more volatility around decisions made far from trading screens. Silver's uncomfortable role is the reason it attracts attention during periods of transition. It reveals stress in the system before the stress becomes obvious elsewhere. Those who treat it as just another ticker miss the signal. Those who study its position see something more important, a material that exposes the limits of free market pricing in a strategic world. That is why silver keeps returning to the center of the conversation, and why its minimum price, if enforced, could reshape more than just one market. When people talk about resources, they usually imagine mines. They picture maps, flags, and deposits in the ground. This focus feels logical, but it is misleading. In modern economies, power does not come from owning raw materials. It comes from controlling what happens after the material is extracted. The real leverage sits in refining. Refining is the quiet middle layer between rock and product. It is where ore becomes usable metal, where impurities are removed, and where materials are shaped to meet industrial standards. Without this step, resources are little more than potential. A country can sit on vast deposits and still be dependent if it cannot process them at scale. This is where many supply chains become fragile. Mining can expand or contract relatively quickly compared to refining. Refining requires large upfront capital, long permitting processes, specialized labor, and strict environmental controls. Once built, plants are difficult to move and politically hard to approve. These barriers make refining slow to scale and slow to replace. For decades, many economies chose to outsource this step. The decision made sense at the time. Refining was expensive, messy, and unpopular with local communities. It was easier to import finished material than to deal with the waste, the water use, and the regulatory burden. Over time, this choice created a concentration of expertise and capacity in a small number of regions. That concentration now looks less like efficiency and more like exposure. When governments discuss price floors for metals such as silver, they are not really talking about mines. They're talking about refining survival. A price floor helps justify investment in facilities that might otherwise fail during price downturns. It provides a predictable revenue environment for projects that take many years to break even. Without this support, refining capacity tends to disappear quietly. Plants shut down. Skilled workers leave. Equipment is sold or scrapped. When demand returns, the capacity cannot be switched back on. It must be rebuilt from scratch. This is why refining acts as a bottleneck. It cannot respond quickly to price signals. Markets assume flexibility, but refining resists it. The result is a system that looks fine until it is suddenly constrained. Silver highlights this problem clearly. Its refining process is often integrated with other metals. Decisions made for copper or zinc affect silver output. If refining margins collapse, silver supply falls even if demand remains strong. Price floors aim to break this cycle by protecting the economics of the middle layer. From a strategic standpoint, refining also concentrates power. The country or region that dominates processing can influence the supply without owning every mine. Control of refining allows for selective access, prioritization, and leverage during negotiations. It becomes a gatekeeper rather than a participant. This is why policymakers increasingly describe refining as a national security issue rather than an industrial one. It sits at the intersection of economics, environment, and geopolitics. Losing refining capacity means losing the ability to act independently during disruptions. For businesses, this shift has practical consequences. Companies that depend on refined inputs may face longer contracts, higher prices, or stricter sourcing requirements. Just-in-time models become riskier. Inventory strategies change. Supplier relationships grow more political. There is also a timing problem. Even with strong policy support, new refining capacity takes years to come online. Permits must be approved. Communities must be convinced. Equipment must be ordered. Workers must be trained. During this period, the system remains tight. Price floors do not eliminate shortages. They attempt to prevent future ones. This creates a window where volatility can increase rather than decrease. Markets adjust to the policy signal faster than physical infrastructure can respond. Speculation fills the gap. Businesses that misunderstand this lag may assume stability that does not yet exist. Another overlooked factor is waste management. Refining produces byproducts that require long-term handling. These costs do not disappear with higher prices. They must be planned for. Regions that avoided refining in the past often lack the regulatory frameworks and expertise to manage these risks quickly. As a result, refining capacity cannot simply be relocated at will. It grows where legal, political, and social conditions allow it to survive. Price floors try to make these conditions tolerable, but they do not remove friction. For young entrepreneurs, the lesson is structural. Control does not always sit where value is created. It often sits where transformation occurs. Understanding where bottlenecks form is more important than tracking where resources are found. Refining is invisible to most consumers, but it shapes the availability and cost of everything from electronics to energy systems. When it becomes a policy priority, it signals that authorities are preparing for stress, not abundance. This is why refining now stands at the center of the price floor discussion. It reveals a system that cannot rely on flexibility alone. It requires planning, protection, and patience. And once refining becomes strategic, markets no longer operate on price alone. They operate on permission, capacity, and time. That is the quiet shift taking place beneath the headlines, and it is where the real game is being played. A price floor is often presented as a stabilizing tool. The language used is calm and reassuring. It suggests protection, predictability, and support for long-term planning. But once markets move from free pricing to managed pricing, new dynamics emerge. These dynamics are rarely discussed in headlines, yet they shape outcomes more than the policy itself. Managed markets do not remove volatility, they relocate it. When a floor is introduced, the downside is limited by policy, but the upside remains uncertain. Prices can still overshoot. They can still spike on fear, speculation, or supply disruptions. What changes is not the existence of risk, but who absorbs it. Some risk shifts from producers to consumers, some shifts to governments, some moves into less visible channels. One immediate consequence is cost transmission. If a material cannot fall below a certain price, manufacturers lose a buffer they previously relied on during downturns. Margins tighten, pricing power shifts upstream. Companies that depend on thin spreads feel pressure first. They may raise prices, cut output, or relocate production. This is where policy intentions and business reality can diverge. A price floor designed to protect supply can unintentionally weaken downstream competitiveness. If inputs become structurally more expensive in one region, manufacturers may seek alternatives elsewhere. The result can be a stronger upstream sector paired with a hollowed-out downstream one. Another consequence is arbitrage. When prices are managed across borders, differences in enforcement create opportunity. Materials can be reclassified, rerouted, or blended to bypass restrictions. Traders specialize in exploiting these gaps. Paperwork becomes as valuable as production. Markets fragment into official and unofficial channels. These side markets are not illegal by default. They are adaptive responses. But they reduce transparency and make true supply conditions harder to measure. Businesses relying on official data may misjudge availability or risk. Price floors also invite strategic behavior. If producers know the downside is protected, incentives change. Efficiency improvements may slow, marginal projects may proceed that would not survive under free pricing. Over time, this can increase costs rather than reduce them. Governments try to manage this through conditions, reviews, and compliance mechanisms. Each layer adds bureaucracy. Each rule adds delay. The market becomes less responsive, even as policy tries to make it more resilient. For investors and operators, this means signals must be interpreted differently. A rising price may reflect scarcity, speculation, or policy constraint. A stable price may hide stress building beneath the surface. Managed stability can mask fragility. There is also a political dimension. Once a price floor exists, it creates a constituency. Producers plan around it. Workers depend on it. Regions build expectations. Removing the floor becomes politically painful. Temporary measures gain inertia. History shows this pattern repeatedly. Support programs outlive the conditions that justified them. Adjustments happen slowly, often, after damage accumulates. Businesses that assume policy will reverse cleanly are often disappointed. Another risk lies in coordination itself. Aligning multiple countries requires shared definitions, enforcement standards, and dispute mechanisms. Any weakness becomes an entry point for evasion. The more complex the system, the more fragile it becomes under stress. This does not mean price floors always fail. It means they change the terrain. Companies that understand the new terrain adapt. Those that cling to old assumptions struggle. For young entrepreneurs, the key lesson is caution with linear thinking. Managed markets produce nonlinear outcomes. Small rule changes can have outsized effects. Incentives ripple through layers that are not immediately visible. It also means planning horizons must extend. Short-term price moves matter less than structural positioning. Access to supply, flexibility in sourcing, and contractual resilience become strategic assets. In a managed environment, information quality matters as much as capital. Knowing how rules are applied in practice, not just on paper, can determine success or failure. Relationships, compliance capability, and geographic optionality grow in importance. The hidden cost of price floors is not simply higher prices. It is complexity. Complexity demands attention. It punishes complacency. As markets transition from spontaneous order to guided outcomes, participants must decide whether they are reacting or anticipating. Those who treat policy as noise risk being surprised. Those who study it as structure gain time to adjust. Price floors are not the end of markets. They are a signal that markets are being asked to serve priorities beyond efficiency. Once that happens, the game changes. Understanding those changes is no longer optional. For much of the modern era, money and materials were treated as separate domains. Commodities moved through supply chains. Currencies moved through financial systems. Each followed its own logic. That separation is now breaking down. As governments focus on securing physical inputs, they are also rethinking how value is stored, settled, and protected. This convergence is not ideological. It is practical. When supply chains become strategic, payment systems do too. Countries that worry about access to materials also worry about access to settlement, who gets paid, in what currency, and under what conditions becomes part of the same calculation. This is why discussions about critical minerals increasingly appear alongside conversations about reserve currencies and gold. Gold enters these discussions for a simple reason. It is not someone else's promise. It does not depend on a counterparty's balance sheet. In times of trust, that feature is ignored. In times of uncertainty, it becomes relevant again. This does not mean the global monetary system is about to collapse. Large systems rarely fail overnight. They evolve, they fragment, they add layers. The current shift is less about replacement and more about diversification. Countries seek options, not revolutions. Reserve data often gets used to support dramatic narratives. A declining share is presented as a countdown clock, but reserve composition changes gradually. It reflects risk management, not panic. Holding fewer dollars as a percentage does not imply abandoning the dollar in absolute terms. It implies spreading exposure. What matters is credibility. A currency's role depends on open markets, legal predictability, and the ability to move capital during stress. These conditions take decades to build and can be damaged quickly by policy missteps. No alternative currency can shortcut this process through declaration alone. This is where commodities re-enter the picture. Physical assets provide optionality when financial systems are questioned. They are not replacements for currencies. They are complements. They sit outside digital ledgers and legal frameworks. Their value does not require belief, only utility and scarcity. Silver occupies an unusual position in this convergence. It participates in industrial demand while retaining monetary associations. When material supply becomes strategic, silver's dual role makes it sensitive to both policy and perception. This sensitivity can amplify moves even without structural shortages. For businesses, the practical impact is subtle but important. Currency volatility and commodity policy now interact. Input costs may be influenced by exchange rates, tariffs, and strategic stockpiling simultaneously. Hedging becomes more complex. Traditional models assume independence that no longer holds. Central banks understand this interaction. Their increased attention to gold reflects a desire for balance, not abandonment. Gold acts as an insurance asset, not a growth engine. It signals caution, not collapse. The danger lies in misinterpreting this caution. Narratives that frame every adjustment as an imminent crisis create poor decisions. Panic leads to concentration. Concentration increases vulnerability. A more realistic view recognizes the system is becoming more layered. Multiple settlement paths, multiple reserve assets, multiple trade corridors. This complexity reduces single-point failure but increases coordination costs. For young entrepreneurs, this environment rewards flexibility. Exposure to one currency, one supplier, or one market carries more risk than before. Diversification is not about prediction. It is about resilience. The convergence of money and materials also affects time horizons. Decisions that once optimized for quarterly performance now face multi-year policy cycles. Capital allocation must account for political durability, not just market demand. In this world, silver and gold are not signals of doom. They are indicators of caution. They remind participants that trust is finite and systems must be backed by something tangible. As currencies and commodities intertwine, the message is clear. Value is being anchored more deliberately. Systems are being stress-tested in advance. Those who understand this shift can plan calmly. Those who dismiss it as noise may find themselves reacting too late. The convergence is not dramatic. It is quiet. That is what makes it powerful. When markets begin to change shape, the most dangerous response is speed without direction. Strategic shifts rarely reward those who react emotionally or chase narratives. They reward those who slow down, observe structure, and adjust deliberately. The movement toward managed commodity pricing and strategic materials requires exactly that kind of thinking. The first adjustment is mental. Decision makers must accept that the environment has changed. Markets are no longer driven only by supply, demand, and efficiency. Policy, security, and resilience now sit beside price as active forces. Ignoring those forces does not preserve neutrality. It creates blind spots. For businesses, this means reevaluating assumptions that once felt permanent. Low-cost sourcing is no longer guaranteed. Just-in-time delivery is no longer a free advantage. Long global supply chains are no longer politically invisible. Each of these assumptions worked in a world optimized for efficiency. That world is being replaced by one optimized for continuity. The second adjustment is operational. Companies need to understand where they are exposed. Exposure does not always show up in financial statements. It often hides in supplier concentration, geographic dependency, or contract rigidity. A firm may never touch silver directly and still be vulnerable to its price or availability through secondary inputs. Mapping these dependencies is not an academic exercise. It informs inventory strategy, supplier relationships, and capital planning. Firms that treat this as a one-time review will miss the point. In a managed environment, exposure evolves as rules evolve. The third adjustment is financial. Capital allocation decisions must account for longer policy cycles and slower infrastructure timelines. Projects that depend on cheap inputs or frictionless trade deserve higher risk premiums. Projects that improve flexibility or redundancy may justify lower returns in exchange for durability. This is uncomfortable for many investors. Financial culture often rewards speed and precision. Strategic periods reward patience and margin for error. The difference is subtle but decisive. For entrepreneurs, this creates opportunity. Policy-driven transitions open gaps where new services, technologies, and coordination tools are needed. Compliance, logistics, recycling, substitution, and efficiency all become growth areas. These opportunities favor builders who understand systems, not speculators who chase prices. Another critical shift is informational. In a managed market, official signals matter as much as data. Permits, funding announcements, enforcement actions, and regulatory language become leading indicators. Companies that learn to read these signals gain time. Those who rely solely on price charts lose it. This does not mean abandoning market discipline. It means expanding it. Markets still matter, but they are no longer the only source of truth. There is also a personal dimension. Many individuals operate entirely in what could be called a paper world. Income, savings, and obligations exist as digital entries. This works well when systems are stable. It becomes stressful when purchasing power shifts or access becomes constrained. The appropriate response is not fear, it is balance. Reducing unnecessary debt, improving liquidity management, and maintaining optionality all strengthen resilience without requiring extreme action. Diversification, when done thoughtfully, reduces dependence on any single outcome. The final adjustment is psychological. Strategic periods punish certainty. They reward humility. Narratives will emerge claiming inevitability in one direction or another. These narratives simplify complexity for attention, not accuracy. Experienced decision-makers resist that pull. They ask better questions. What is being protected? What is being subsidized? Who benefits if this persists? Who loses if it fails? These questions reveal structure beneath noise. The shift toward price floors and strategic materials is not a temporary headline. It is a signal of a system being reinforced under stress. Reinforced systems are harder to move, slower to change, and more expensive to operate. They are also more durable. Those who recognize this early do not need to predict outcomes. They need to prepare for a range of them. Resilience, optionality, and patience are not slogans. They are strategies. As markets become more managed, the advantage moves to those who understand why. In that understanding lies the difference between reacting to change and navigating it. The quiet warning is already visible. The response does not require panic. It requires clarity.